All right, let's get right into it. You know that feeling, right? You see a strong move in the market, you jump in, and then bam, it just reverses on you, hard. Well, today we're going to break down a pattern that might just explain why that happens. We're talking about something called a manipulation leg.
So here's the game plan. First, we'll define what this manipulation leg actually is and the theory behind it, which is called the AMD cycle. Then we'll get our hands dirty with two practical tools, standard deviation and something called AOX. And we're going to wrap up with what I think is the most critical part, why you always need confirmation and how all this helps you read the bigger story the market is trying to tell you.
I mean, think about it. The market is trending, it looks so sure of itself, you get in, and then it just completely pulls the rug out from under you. It's one of the most frustrating things in trading, right? Well, there's often a specific reason for it, and that's what we're digging into.
And the key to understanding these sudden, sharp reversals, it often comes down to spotting what our source material calls the false move. We're going to call it the manipulation leg.
So what is this thing exactly? Well, imagine the market is just kind of chilling, moving sideways. Then all of a sudden, you get this huge, aggressive price spike. Its whole purpose is to fake everyone out, to make you think it's breaking out right before it reverses and goes the other way. It's a trap, plain and simple.
So why does this even happen? Is it random? Not according to this theory. It's all explained by something called the AMD cycle. It's a really simple three-step framework that helps make sense of the chaos.
Okay, so here are the three phases. First up, you have accumulation. This is that sideways, boring period where the market's just building up orders. Then comes the manipulation phase. That's our false move, that aggressive spike designed to hunt for liquidity. And finally, you get the distribution, which is the market's real move, the direction it intended to go all along. AMD.
All right, that's the theory. But how do you actually trade it? Well, the main tool our source recommends for finding a potential entry after that manipulation happens is the standard deviation tool.
And the beauty of using this tool on the manipulation leg is its simplicity. When you apply it, it's not going to give you a million lines to worry about. It generates just two key levels that we need to pay attention to.
And these two levels are called the minor and major levels. Think of the minor level as the first potential stop where the market might turn around and get back on track. If it blows past that, the major level is that deeper, more extreme area of interest we'd be watching. Okay, here are the exact settings you'll need to plug in. Our source gives these specific parameters to get the tool working just right. This is a good spot to hit pause and get this configured in your own charting software. So let's walk through a buy setup together. You see that sideways accumulation, and then, boom, a sharp move up. That's your manipulation leg. What you do is draw the standard deviation tool from the very high of that leg down to its low. And what it does is project those minor and major levels below the price, giving you two potential zones to look for a buy.
And for a sell, you guessed it, we just flip the whole thing upside down. You see a sharp drop after that sideways action. This time, you draw the tool from the low of that manipulation leg up to its high. The tool then projects the minor and major levels above the price, giving you potential areas to look for a sell entry.
Now, to give ourselves a little more confidence in these levels, the source suggests we add a second tool for confluence. It's a very specific Fibonacci setup that's referred to as AOX.
So this AOX tool is basically a customized Fibonacci tool. It's specifically designed to pinpoint really precise entry points on those strong impulsive moves, which makes it the perfect partner for the standard deviation levels we just found.
And of course, here are the exact settings for that AOX tool. Again, feel free to pause right here and copy these values down. A good tip is to save this as a template on your trading platform so you can pull it up with just one click. Now, this part is absolutely crucial. The source makes a really big point here. Don't go crazy with this. You're not trying to mark up AOX zones all over your chart. The goal is to find just one clean, obvious impulse move per session. Seriously, remember this. Fewer zones mean more clarity, less is more. Okay, let's get to what is, without a doubt, the most important part of this entire strategy. We need to talk about managing our expectations and the absolute necessity of waiting for confirmation. This is the reality check every trader needs to hear. Our source is very upfront about this. The strategy is claimed to be effective about 70 to 80% of the time. Now, that's a pretty strong number, for sure. But what does it also tell you? It tells you that 20 to 30% of the time, it's not going to work. It will fail. And this quote from the source really says it all. There is no holy grail in trading. It just doesn't exist. No strategy is perfect, and really internalizing that fact is key to your survival and success in the markets. So, how do you deal with that 20–30% of the time it might not work? Simple. You always wait for confirmation. You never just blindly trade a level because the line is there. You look for other reasons to believe the price will turn. Is there a big area of support or resistance from a higher time frame? Is there an order block? You need other clues that tell you, yes, this is a good spot to take a shot.
So let's tie this all together now. This isn't just about drawing some fancy lines on a chart. It's about learning to read what the market is actually trying to tell you. It's about understanding the story.
What this whole framework really gives you is a narrative. You see the market in its accumulation phase, building up steam. You spot that manipulation leg for what it is, a deliberate hunt for stops and liquidity. And then you're in a position to anticipate the distribution phase, which is where the market really wanted to go all along.
By understanding this pattern, you stop just reacting to price movements and you start anticipating the market's next chapter. So I'll leave you with this question. With this new perspective, the next time you pull up a chart, what story is it going to tell you?